Do you feel lost when people start talking about stocks and bonds? Do you feel like you're swimming in a sea of complicated terms and don't know where to start? In this video, I'm going to break down the top 5 financial terms that every beginner should know. These are the words that are used a lot in news and random conversations about stocks, so it's important to have a good understanding of them. By the end of the video, you'll be able to hold your own in any conversation about money. You'll understand what stock split is, what the difference between revenue and net income is. No, they're not interchangeable. And more. Let's go. For those of you who are new to the channel, welcome. My name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing as this will help the channel grow and impact more people. Here are the top 5 financial terms that every beginner should know. Number 1, revenue. Put simply, revenue is the money that a company brings in through its business activities. This can include money earned from the sale of products or services, as well as any other income streams such as interest or rental payments depending on the business. While revenue is not the same as profit, which we'll cover next, it is still an important metric for measuring a company's overall performance. Revenue is the lifeblood of any organization, small or large. It is what keeps the lights on and the wheels turning. Without it, businesses would grind to a halt. It's also known as the top line on a company's income statement, and it represents the total amount of money earned during a given period of time. In short, revenue is everything a company brings in. If a company's revenue is increasing, that usually means that it's doing well and attracting more customers. Conversely, if revenue is decreasing, it may be a sign that the company is struggling and need to take corrective action. Understanding a company's revenue is essential for making informed investment decisions. Nevertheless, revenue shouldn't be the only metric to take into account. Number 2, net income. Also known as the bottom line, net income is the profit that a company has earned after all the expenses have been paid. This includes things like what it costs to make the product, all of the operating expenses, interest on the company's credit, and taxes paid to the government. To calculate net income, you simply take the company's total revenue and subtract all of its expenses. So if a company has, say, $100 in revenue and $50 in expenses, its net income would be $50. Net income is important because it shows how much money a company is actually making. It's also a key metric that investors look at when deciding whether or not to invest in a company. Number 3, stock split. A stock split is when a company divides its existing shares into multiple new shares, and as a result, the price per share decreases. This is usually done to make the shares more affordable so that more people can invest in the company. For example, if a company has 100 shares that are each worth $100 and they do a 2-for-1 stock split, then there will be 200 shares that are each worth $50. A stock split does not increase the value of shareholders' investment, but it does make it more affordable, which can attract new investors and drive up the share prices once again. While some investors see stock splits as a positive sign, others view it as a way for companies to artificially inflate their share prices. Ultimately, it's up to the individual investor to decide whether or not a stock split is a good thing. Number 4, share buyback. A share buyback, also known as a share repurchase, is when a company buys back its own shares from investors on the open market. The main reason companies do this is to increase the value of the remaining shares since there are fewer shares outstanding. This can be a good thing for shareholders since it can lead to a higher stock price. However, it's not always a positive development. For one thing, it can be a sign that the company doesn't have any good ideas for how to use the cash. And if the buyback is financed with debt, it can put the company at risk if the stock prices falls. So while a share buyback can be a good thing for shareholders, it's not always a positive development for the company itself. And finally, number 5, market capitalization. More commonly known as market cap, it is a measure of company size. It is calculated by multiplying the total number of shares outstanding by the stock price per share. In other words, it is a way of estimating how much a company would be worth if you could buy all of the shares and then sell them off at the current market price. The market cap of a company can give you a quick sense of how big it is relative to its peers. For example, Apple currently has a market cap of around $2.6 trillion, while Microsoft is around $1.7 trillion. That means that Apple's is worth roughly 33% more than Microsoft. Of course, the market cap isn't the only factor you should consider when assessing a company, but it can be a helpful starting point in your analysis. These were the top 5 financial terms that I wanted to share with you today. Let me know in the comments down below which one was new to you. If you liked this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and I'll see you next time. As the top line, market capitalization. Where? Oh. Yeah.